to give us an economic outlook on what we can expect coming down the pipe in 2021. And I'm sure a lot of us are going to be taking mad notes. Feel free to put your comments in the chat as you like, and we can go ahead and hear from Miss Lynn. Miss Lynn, welcome.
Thank you so much, Stacy. Can you all hear me okay?
She powered through the technical issues this morning.
Of course, the computer crashed right before this call, but
that's the only time it does.
They installed a new driver, so we're good. So thank you for your patience. But the economy, I'm not sure is going to be so patient. So I guess there's a few things. So there's a few things to talk about this morning. I was busy revising the slides while they were installing a new driver. So a lot of things going on. But let me share the screen with you. Stacy, I think you've probably given me permission here to do that. Alrighty, are you seeing my slides? Terrific. Okay, so this morning what I thought we would do is talk essentially about 5 topics. The global outlook, I always like to start from the top and then narrow it down like a funnel, and then speak about some of the recent trends we're seeing in the US and locally, California, Orange County, and San Diego. Look at some of the policy prospects with the new administration coming in, the outlook for 2021, and then finally some concluding remarks and maybe some recommendations on how to run your business in this crazy economy that's changing all the time. So first of all, in terms of the global outlook, this is very important because as we know, China was hit first by the coronavirus. But what has been astounding is how quickly China's economy has rebounded. See now, if you look at its Purchasing Managers Index, which basically shows the percentage of companies that are saying things are getting better as opposed to worse. So anything above 50 represents expansion. You can see that it is actually at a 3-year high. So the Chinese economy started out rebounding in terms of manufacturing. They pushed industrial production, steel, infrastructure building, and now consumers are starting to come back to restaurants. And in fact, you might be interested to know, just recently, we were on a call. They banned Zoom in August, but they have their surrogate. And we have some Chinese clients, partners, and they were on the call and they were around a conference room, all sitting next to each other, no mask. It was like, wow, this is different. But that was what I was very interested in seeing. Now, if you look at the rest of the world in general, you can see indeed that the rest of the world has benefited from the Chinese recovery because the name of the game is export to China. That's where all the action is happening. And so any economy that's benefited from that trade, Australia, some of Europe, even the US, everyone is seeing the pull from China. China indeed is the magnet. And I know we have this bilateral trade war going, Cold War with China, but nonetheless, China is really right now acting as the major driver and escape clause for this very dire recession. And if you look at the forecast for the current year, you can see that it's pretty glum across the spectrum. We are, of course, seeing the second wave of the virus hit very hard in Europe as you know, as well as the US. But there's been very few places that have escaped the downturn, with the exception of China, which is likely to show about a 2% gain. But look at the astounding losses in Europe, 9%, close to 10% in Latin America, Canada, Africa, and we'll talk about the US later, but the whole overall world down nearly 4%. So it's been pretty grim. We started to see some signs of recovery in the summer, but that might have been an issue because that caused a lot of people, for instance, in Europe to relax. And as a result, the virus just came back with a vengeance. And now they're having to go through a whole new set of shutdowns, which is also, of course, being seen in this country. Now, what's happening in some of the key indicators that affect all of us, oil prices, we had seen them really rebound after the financial recession. They actually were, you can see here, way up over $70 a barrel. I mean, you believe that? And then they crashed down early this year. And in fact, you may recall, if you were watching this kind of stuff, that oil was actually in negative prices. So what does that mean? I mean, it was meaning that people were paying others to just take the oil away. That's how bad it got. Now we've rebounded to around $45 a barrel. But my expectation is we're not going to go back to 80 or 60. Maybe we get to 45, but it's going to be pretty much capped here for two reasons. We know that everyone, even British Petroleum, BP, is going to zero net energy. And we're seeing that most companies are really trying to focus on global warming and really reduce the use of traditional fuels. And also any kind of sign of life of prices, you're going to see OPEC members, Russia, Saudi Arabia, and even US producers start to pump more oil. So I think that's going to keep prices capped without them really rebounding very much. Now, the other issue is interesting, is the dollar. Along with gold, recently, dollar has become the safe haven. So if you were worried about war, if you were worried about financial crises, if you were worried about pandemics, where did you go? You went to the US dollar. Everyone loved the dollar, and you could see it just really soaring here. But recently, sort of ironically, the vaccine has prompted expectations that it won't necessarily just be the US that benefits. In fact, as you know, UK is out in front with the approval. So that other countries will be looking more attractive, and some of the dollars, the money that's been coming to American shores is now going to go out and look for undervalued assets in Europe or in emerging markets. And so, we're not talking about a dollar crash, but we are talking about some tempering of the dollar's movement after reaching these sky high levels. Now, there's been a lot of speculation. What will the new Treasury Secretary, Janet Yellen, do with the dollar? As you know, it's the Treasury policy purview to determine any kind of view on the dollar. The Fed, that's not its role. It's the Treasury. And in the last several years, the Treasury has basically said, we're not going to try to manipulate the value of the dollar. And this has probably been a wise stance because, as it turns out, there's really limited ability for a government to control its own currency. There's just, trillions of dollars that are betting possibly against you. So as a result, I think we'll just see this moderate decline in the value of the dollar, but nothing dramatic. But this actually will be good news for our exports that will make us more competitive, and good news for multinational companies that are getting their profits then returned here at higher levels of value. Now, what's been happening here on this side of the ocean? Well, there's been good news and bad news. So here you can see US manufacturing very strong. And this recession has been like none other. Typically, manufacturing is the one that takes the big hit. Services pretty much stay above ground. In this particular downturn, as you know, what's happened? Just the reverse. People are buying stuff. Companies are therefore having to manufacture everything from disinfectant to TV sets to refrigerators. We're also exporting to other countries. But services, not so much. That's the face-to-face stuff. And we can or we don't want to go to movies and dine out. We can't take cruises. We don't want to fly airplanes. And so that's been the dichotomy. And I was just, reading an article this morning that, the cruel irony of that is that, most of the jobs are in the service sector. Those are where you really need the people. The manufacturer, you can pretty much just ramp up productivity, and you can even keep adding to inventories. But services is where the job hits have really been severe. And the dynamics of the economy this year have been absolutely dramatic. You can see that we had, and this is an annualized rate, GDP plummeting at an annualized rate of about 33% in the second quarter. And then we rebounded at over 30% in the third quarter. Now, of course, this is not an offset because, if you drop 100%, you have to increase 100% from that. It's still not even. So we're still down about 3% from where we started the year, but we're making some progress. The fourth quarter looks pretty wimpy here, but it's still likely to be close to around 5%. But let's drill down now into what's happening in real time. This chart, I think, is absolutely horrifying. This shows COVID cases, and we thought, you think about it, seems like the really bad news was last spring, right? Look at this. This is where we are as of today. We're way, way, way above where we were last spring. This is really scary. This is really very, very serious. And it looks like, from my point of view, that Thanksgiving and Christmas are probably going to be what we would call super spreader events, because people just thought, they get together with their family members, they know their family members, they get together with their friends, they know their friends. And, I just was talking to some younger people yesterday, and like 4 or 5 of them all got COVID, and their friends all that they weren't even with, they all got it. So this is not a good situation. Consumers in the US economy are, as you know, about 70%. So we need to keep them energized. So it's pretty interesting what's been happening on the consumer side. We see that consumer confidence really plummeted, and it's come up, it's kind of down recently. But let's look at consumer behavior. Those $1,200 stimulus checks really had an impact, along with the $600 extra money that people got every week on unemployment. That had a huge impact, and people spent it on all kinds of things. And, you know, you can see that these are percent changes. So they look, again, pretty wimpy, but consumer spending is still going forward. And consumers that are still employed, working from home, they're doing fine. And so we've seen, in fact, personal income, although, you know, you had this spike with the $1,200 checks and what all, personal income is still way above its level before we started the pandemic, which you have to like, wow, is that really true? I mean, that seems unusual. It seems like we're in this bad recession, but you can see that actually total personal income is well above where it was, even though spending is down about 3% from where it was. And so what's happening with all this income? Well, people are still saving it. The saving rate has come off its peak, where like, look at that, 35%. I showed this chart to one of my friends, and you know what he said? He said, Lynn, that's un-American. I said, okay. But you can see that the saving rates come down, but it's still nearly 15%, well above what it was. And the banks are like seeing dollars just, you know, flood into their vaults. So people are saving it, and they're like, I think we're going to be willing to still spend for the holidays. What's happening locally? Well, here you can see the percent change from February, which was the pre-pandemic stage. And what's happening here is that the US is in the lead. California's, we've been more cautious and trying to, you know, clamp out the virus. San Diego has recently overtaken the state in terms of its recovery picture. And Orange County is lagging both. And then if you look at it in terms of how much of our jobs have we recovered from that February pre-pandemic high, you can see that in terms of the US, we're at about 93%, which means we're down about 7%. San Diego is about 92% of its way. California's less than that, and Orange County trails. So that's kind of like our scorecard that we're watching carefully to see how we're doing relative to the recovery. Now, what's really interesting is the dispersion across different parts of the economy. This is a very uneven recovery. You've heard a lot about demographic groups, and clearly low-income workers are being affected, some of the minorities being more affected than others. So it's very much the K type of recovery that you've heard talked about. But it traces to the division of industries. So let's start with the good news. Construction. It has passed its pre-pandemic peak. It's at 103% of its pre-pandemic employment. Construction, home building is booming. Utilities, professional business services, they've totally caught up. On the other end of the stream, look at leisure and hospitality. That is where the pain has been felt dramatically. Only less than 80%, which means that we're seeing a decline. We're still lagging. Fifth of the workforce in leisure and hospitality is still out of work, which is absolutely astounding. Now let's look at the jobless rate. You can see it's dropped significantly. skyrocketed up close to 16% in San Diego. It's come down dramatically, although currently it's 7.7%, which still means that it's more than double what it was before the pandemic started. So we still have a long way to go. And, think about it. Before the pandemic started, what was the biggest complaint of businesses? How do I get the workers, right? I mean, that was the whole problem, that businesses couldn't find people to work for them, to even show up for the interview. And now the tables have definitely switched. As I mentioned, the housing market, there was, I contribute to this poll of people that contribute on the yes or no questions on Sunday in the San Diego Union Tribune. And I remember the question that said, what was going to happen to home prices this year? And, I kind of thought, well, it's going to be a race to the bottom, supply or demand. But I did say prices would be up, but I did not think it would be up this much. This is at the end of September, but San Diego was showing, of the 20 major metropolitan areas, San Diego was number 3 in terms of home price appreciation, up 9.5% versus a national gain of about 7%. So, it's like everybody, even they had to do the virtual looking for houses, they have been out there, and it's been fueled by record low mortgage rates, people that still have a job. And so as a result, the housing market, refi activity, mortgage activity, they're actually on fire. Okay. So the third issue is what's coming down the pike with new policies. We have a new administration in town, we think, soon. And so what's coming, and again, this is one of the slides I was revising this morning, because as you know, it looks like we possibly might finally have a deal before year end, although it's pretty tentative. But the plan looks like we may have kind of a skinny package of stimulus to kind of tide us over, because a lot of these federal programs will expire by the end of the year. The clock is ticking. And then the Biden administration will come in and try to get some more expansive programs going on. But what we're talking about, definitely the jobless people are going to get more benefits. At a minimum, they're going to have the pandemic extra relief extended. And the latest compromise would take the $300 extra federal dollars per week and extend that through about March. And so I think that would be something we can look for. Definitely everybody wants to help small business, so an extension of the Paycheck Protection Program. Everybody is supportive of more assistance for getting more of the vaccinations out there, support for schools, and then not immediately, but I think there will be momentum sometime next year to get an infrastructure spending bill done. That was something that Donald Trump wanted to get through, and one of the reasons he won the election. A lot of people in the Midwest actually had, in the polls, had suggested they wanted more infrastructure spending. So we might get a bill to support that. Now, on the side of monetary policy, the Fed is right now committed to growth. Chairman Powell from the Fed has indicated that ad nauseum. He says, we're focused on growth. We're not worried about inflation. In fact, we're letting inflation run above our target 2% for a while because we really want to get the economy back on track. The Biden administration, they will come in and it looks like they will have at least one vacancy to fill. The Trump administration looks like it won't be able to get Judy Shelton approved in time. The other one will get filled with Chris Waller. So the Biden administration will have one Fed governorship to fill probably immediately. And then in 2022, Chairman Powell's term as chairman comes up. So we'll see what President Biden wants to do at that point. Meanwhile, in real time, what is the Fed up to and what it's not up to? Well, it's pretty clear that it wants to keep its foot on short-term interest rates. It's made that very, very clear. It doesn't want to go negative interest rates. It has pretty much come out very clearly that it does not want to take interest rates to a negative zone, but it wants to keep them capped in a little narrow zone of 0 to 0.25. Moreover, it has indicated that it wants to probably keep those rates there for quite a while through 2021, through 2022, and probably through 2023. I mean, that is astounding. And meanwhile, it also is using its other primary tool to swell its balance sheet. It is buying all kinds of treasury securities, $80 billion per month, and mortgage-backed securities, $40 billion per month. And here you can see its balance sheet. Look at this. It now stands at about $7.2 trillion. Just since the pandemic started, the Federal Reserve has added over $3 trillion to its balance sheet. Now, where does that money come from? You got it. It just prints it, not literally, but it essentially prints that money. And so it's actually been helping the Treasury finance its stimulus package because it's been buying a lot of those treasuries. And again, we haven't seen inflation. Interest rates have stayed down. So it looks like the game can continue. Meanwhile, the stock market is loving it. It, got setbacks from time to time, but now, it looks like a vaccine is coming and it looks like the economy will rebound. So stocks are very happy. And stock market volatility has dropped dramatically. This is this VIX index that some of you may be aware of, and it's down to about 20, which indicates that investors are, not, the nervous Nellies they were at the pandemic surge. With the pandemic rise, they're very calm, they're very happy, and it's like everybody's saying, man, it's fine. We got, the Fed's got our back, the new administration is going to be stimulative, the economy is going to help, and so times are good, even though the economy is definitely losing momentum. So what's the outlook for 2021? Well, I can't lie to you, I'm pretty optimistic. I mean, you just got to be. It looks like the majority, everybody that wants a vaccine should be able to have one by the end of May or into June. The question is whether or not they will take it. We need about 75 to 85% of Americans actually to get vaccinated, as you probably know, to get what we call herd immunity. But it does look like we have a good prospect of seeing recovery significantly in the spring, summer, and the second half of next year. So we're looking for the economy to drop about 2.5% this year, and then a rebound about 3.5% in 2021. Inflation is likely to pick up, but I don't think it's going to be surging. It's going to be probably around 2%. And on the interest rate front, here's where we see the dichotomy. Short-term interest rates are under the control of the Fed. Long-term interest rates, no. The Fed can try to influence them and say, we intend to keep interest rates low, but they're targeting this short-term rate. Long-term rate is looking forward. And so this morning, it's like 0.95. So we're forecasting it's going to be like closer to 1.75% by the end of these next year, which will take mortgage rates up to maybe 3.5% from 2.75% now, which would still be pretty moderate mortgage rates. But what can the Fed do? Well, it could start to buy a lot more of these longer term treasuries. It's tried that in the past. It hasn't been particularly successful. But if long-term rates are rising because investors are looking to better news of the economy, I'm not sure the Fed wants to stomp that out. So I think probably the expectation is that rates still will rise on the long end. And then here locally, the good news is that tourist sector, which has been absolutely devastated, should be bouncing back by summer. People going on vacations, going to concerts, going to restaurants, staying in hotels. California exports should be recovering with a weaker dollar and growth in Europe and the rest of the world. Construction is likely to remain strong. And as a result, in California as a whole, Orange County and San Diego, we should see more jobs, further reductions in the jobless rate. Although the downside will be the government finances, even with some federal assistance, are probably going to be under pressure as we see the lagging impact of the recession. So in conclusions, I think that first, this year, it's been a horrible year. I mean, I think we just all want to, in fact, when we changed to regular time, someone said, do we really want an extra hour of 2020? I mean, you had to wonder about that question, with the exception of China. And US and California, as I showed you in the slides, we have seen some signs of recovery, but now it does seem to be threatened. We're in purple zone. It looks like the infections are going to continue to rise. This is going to be a very nasty several weeks. And so that could threaten the recovery, particularly as federal benefits run out, unless they're given a lifeline. Hopefully they will be. But then things change in 2021. We're going to be getting expansive policies. I think with the new Biden administration, even if it's a split Congress, they're going to be trying to do everything they can. And Biden, knows the people in the Senate. And so I think he'll be trying to compromise. And finally, the most promising thing is the vaccine. That is what's going to enable the economy finally to shake off this very serious downturn. So what does this, mean for you in terms of 2021? So, I kind of thought of a few things for possible consideration. First of all, now, if you haven't already, start to prepare a post-pandemic strategy. I teach a couple of MBA classes, and the first question I asked them at the beginning of the semester is like, well, what do you think will be changed after we get out of this pandemic and what will endure? So you got to think about that for your own business and start to plan that kind of strategy. Don't wait till June. You got to do it now. Second, develop vaccination policies. Are you going to require all your employees to take the vaccination? Are you going to have opt-out possibilities? What do you do about the people who do opt out? What do you do with them? So you got to think through that policy, because there may not be like a state mandate or a national mandate that you have to get vaccinated. Third, this whole issue about inventories. The old days, it was always about just in time. You wanted to cut costs, so you kept inventories as skinny as possible. But now the new game in town is have inventories so that you don't run out. It's kind of the just in case situation. And so we know that supply chains can get clogged up and delays. And with interest rates so low, if you do a cost benefit analysis, you may want to have an error on the side of a little more inventory as opposed to less. And then the fourth point has been one I've been spending quite a bit of time thinking about and paying attention to and asking various people in the region about. And this is the area about skilled workers. And it started out with cyber workers. Companies are generally thinking, well, this is a downturn, the unemployment rate is high, so we don't have to pay much for workers. Wrong. You've got to, if you're talking about childcare, for instance, you certainly have to pay more for those people because it's hazard pay. Cybersecurity workers, you can't just pay them tiddlywinks. You've got to pay up significantly. And you're going to want to pay for your good workers. So it's not the old days where you had a recession and workers were kind of like happy to get any kind of money they could for skills that you want, for people you want to retain. You're going to have to pay a significant wage to attract those workers. And finally, I haven't been able to say this for a long time, so I'm announcing to you this for the very first time: be optimistic. Better times are indeed coming. And I think, a year from now, it's going to be a whole different game, And so just basically hang on until we reach that better news. And we're talking, 6 months, so we can do it. All right, with that, let me stop and please ask any questions that you may have. Thank you.
Thank you, Lynn. That was amazing. Yes, guys, feel free to unmute yourselves and jump in, or you can put your questions in the chat and we will share them with her for sure. So we'll let folks have a minute to transition.
And the only dumb questions are the ones I can't answer, so don't be shy. Or tell me what you think.
So do you have any thoughts on real estate and the various sectors of it, and in particular as these moratoriums of evictions and all this talk of everybody is going to be evicted January 1st after these moratoriums are over, et cetera? Can you kind of talk about some of the real estate and the economics related to that maybe?
Yes, we're actually looking at that situation. As you know, we have several moratoriums that have been announced, the federal level, the state level, and the city level. And right now, the state is the most restrictive. The moratorium goes through the end of January on that one. So this is a risk. There's a lot of people, we're now actually doing a major poll on this of landlords, apartments, but there's a significant risk of evictions taking place. And also a lot of the evictions that for purposes of just health issues or unsafe behavior, people that should have been evicted in normal times with the courts being closed last year, those evictions never took place. So they're likely to happen. We're likely to see some negotiations. There's already in this skinny bill that's being considered by Congress, a modest amount of rental assistance. I think we will be seeing the city and maybe the state trying to come up with some more rental assistance programs, but it's not going to be enough. And so we are going to see a big problem. There's going to be a lot of negotiation that's going to have to happen between apartment owners and renters in terms of paying back all of the missed payments since last March, because of course they have not been forgiven. It was just a delay. So there's going to be a big problem in meeting those unmet bills. And if you don't do it, you're going to be causing problems for the landlords. So that's a big problem that's going to have to be dealt with. And I think, the only way to deal with it is for a significant amount of rental assistance to be coming from the federal government, the city, the state, the county, with the latter groups being really stretched for funds. And then second, a landlord renter negotiation to try to figure out some payment plans, which could take the better part of a couple of years.
We have another question for you, Lynn. Where do you expect home prices in San Diego to go after the vaccine is out?
Well, I think they'll remain strong because I think you're talking about one, demand remaining even stronger as we see more jobs coming in, the unemployment coming down, and more optimism. People are going to be more confident. Mortgage rates will be higher, but as I say, they may go from like 2 3/4 to maybe 3.5%. But people may be worried that they're going to go even higher, and prices are going to be going higher. And the reason the price is going to be going high, not only because of demand, but supply. Builders will be trying to build more houses, but reality says they are seeing supply constraints. Regulations. As you may have known, we did a study a few years ago, and regulation accounts for about 40% of the cost of building a house. And it's not just the regulatory fees, it's all the process. They're trying to streamline that, but it's still very restrictive. And then you have all the NIMBYs. I mean, you pick up the paper every day and there's, a voter restriction on a building project, or there's a court case or something that blocks a major building project. So supply is still constricted in the region along with just land, but basically it's more policy and public resistance while demand remains strong. So I think home prices are not going to be rising probably by double digits, but they're going to continue to rise.
I have a different question for you. How will new higher tax rates impact state and national movement of jobs and therefore their respective economies?
Well, we don't, depends on what happens in Georgia. I mean, January 5th is absolutely critical. Actually, my colleague is a voter in Georgia. So that Senate race will be critical. If the Republicans take it, it's going to be very hard for Biden to get through a big tax increase at the national level. That's not going to happen. Now, if they get the majority if the Senate has a 50-50 split, then he can get that tax increase. So that's a big question. State, we're not talking, well, they might raise the taxes, but even if they don't, tax rates are high. We will see. Right now, we're already seeing out migration, and we've seen this for a number of years of domestic. There's more people coming in from other states. More people going out to other states than coming in. That's partly due to housing and partly due to taxes. And some of the corporations, we just saw Hewlett Packard move to Texas. Tesla's moved to Texas, a manufacturing plant. So we'll see more of that. That doesn't prevent California from continuing to expand. There's still companies and people leaving, but nonetheless, California's economy continues to grow as expansion is happening here. But people can vote with their feet and taxes do matter. So those tax policies will have a consequence.
Are there other reasons, and you might have touched on this a little bit already, for the unprecedented price increases in home prices across the country besides low interest rates?
Well, I think it's also the working from home, because we've seen now the pandemic. So we've seen the house now become not only a place to live, but it's become the entertainment zone. It's become the recreational zone. It's become the education zone, the working zone, as well as the living zone. So you've got 5 reasons for that house. And so people want more space. And they've also, as you know, been moving out of the cities to get that more space. So that has caused, a lot of churn in the real estate market. And it's also been driving up prices in areas that had not seen the rise before. So it's not just a split in the mix. We've obviously seen prices go down in New York City, but it also reflects the demand for more space, more focus of the larger parts of people's savings now is going into housing. They've been holding back, and now they say, well, that house looks like a good investment because I'm going to spend a lot more time there than I used to. And it's going to be, hard to kind of turn that clock back quickly.
You missed the one critical zone in our house, which is the strangle zone for the kids who don't listen. But
okay, right. Good point. Yeah, there's always the basement, right, or the corner, the closet.
Thank you. For
or
that,
when I grew
Lynn.
up, it was the stairs. We had to sit on the stairs until we began.
All right, one final question for you. Can you expand on outlook for owner-user office market sector in San Diego? Currently, there's low inventory and prices have remained pretty stable. Will this change in 2021, do you think?
The owner, well, it depends what kind of building you're talking about, what the use is. If you're talking about industrial buildings, they're going to be very strong, particularly warehouses. It's all this shift to online shopping, as you know, has been dramatic. We're basically where we thought we would be 5 years from now. It's all happening now. It's going to slow down some, but it's going to continue to expand, which means that companies need more warehouse facilities and they need that closer in. I think you'll also see some of the demand for maybe manufacturing, and you'll see some demand in the suburbs for offices that are closer to where people live, because although more people will return to downtown than I think was thought maybe 2 months ago, people will want to be back with their companions. Companies will want to see that collaboration, but everybody's been surprised how well people have worked out of their own homes. So in many cases, companies may want to establish satellite offices, smaller offices out where people live. So it's closer to them. So that could be a benefit there.
Well, that's been fantastic insights, Lynn. I know that I took some fast notes and I particularly love the optimistic bullet point. I'm going to carry that one as my lightning rod to look forward with for all those planning sessions that are coming up. So if anybody has any questions, her contact information is here. I'm sure I'll give away Lynn's time and I'll say I'm sure she would love to have anybody reach out.
Exactly.
And if you have any other questions, please do be sure to reach out to her and say hello.
Well, thank you so much, all of you, for your forbearance and for listening to the economy so early on Tuesday morning.
Well, thank you for all your wonderful insights. We appreciate that. All right, friends. Well, we are going to transition to our next speaker that comes on at 10:15. So I'm going to give everybody a quick biology break. If you'd like to go check a quick email or use the restroom or refresh your tea or coffee, now would be a great time to do it. Please come join us back at about 10:05, 10:07 is top of the hour right now. So, 5 to 7 minutes and come right back and we'll go ahead and get prepared for our next presenter. Thank you, Lynn.
Thank you so much.
And we've got some great partners. Today, we wanted to share a quick video of RG Alliance and give a shout out to our buddies there.
We're not trying to fit companies into our box. We evaluate what they do really well and try to optimize that. And so utilizing best practice from the experience that our team has, we implement things that improve the way their organization works, align with that organization's goals, rather than trying to show, hey, our system works better than what they already know.
And this is what drives business.
behavior, not cash, not financials, not metrics, not revenue, behavior. Finance is a snapshot of behavior.
What are some of the key challenges you see facing small to medium businesses as it relates to your business?
When you look at how people behave, data is really just a snapshot of minor, tiny behaviors. I mean, there's thousands and thousands of them happen every day. And not knowing what to even track is half the battle. And then once you do track it, knowing what to do with it. And sometimes business owners are afraid of the information, they don't want to know the information, or can't get out of their own. And sometimes embracing what that data is telling them, to utilize it, to reinforce what they already know, and then to change what they don't, really drives the success of their business and really takes them to places they never thought they could go.
Who is your ideal customer?
Nobody generally gets into business to do finance work or data work or system optimization work. And so if they could focus on achieving what they love and then getting the information that helps them reinforce what's going well and change what's going poorly, those are the kind of clients that we're really looking for. Because those are the ones that can actually take the information and make a substantial difference in their business for themselves and for the people that work in the organization.
I just want to personally thank Ryan and his team. I know a lot of our members use RG Alliance, and they just continue to deliver and help many of our member organizations put tremendous points on the scoreboard. So thank you to them and their organization for everything that they do. Was there any, before I move into our next speaker, I didn't know if there was any commentary or any feedback from the last presenter, or if Brian or Jerry, if anybody wanted to share a few words before we moved on. But we definitely have Jackie Reed from TS Restaurants here. So, but I wanted to offer a space real quick. Any commentary? Excellent. Well, good. So I'm actually really excited to hear Jackie speak. We had a nice little email exchange, and I got an opportunity to get to know her just a little bit better. But for those of us who have been here the last couple of mornings and experienced a little bit of hakalau, hakalau is actually, you know, a Hawaiian word. It's a Hawaiian practice. And so I'm pretty excited to learn a little bit more about the legacy of Aloha and what are some of the beautiful things that we can pull out of Jackie's experience. You guys will be excited to know that she's had a tremendous career, even somehow, you know, through all of her work and time commitments, earning valedictorian honors, running a family restaurant, husband, kids. So she's really got kind of the whole American dream going on. So without further ado, I have the great pleasure to introduce Miss Jackie Reed of TS Restaurants.
Thank you, Stacy. I'm really excited to be here. I appreciate the introduction, and I appreciate everyone having me. So I am going to share my screen. I do have some slides, not because I want to bore you with a PowerPoint, but just simply because I'm a visual person. And I use the slides as a visual aid. And then that way I don't have to see my face on the screen talking this for the next 30 minutes or so. But again, I am delighted to be here, and thank you to Brian for inviting me. We actually have a mutual friend, and so it's been a real pleasure to get to know a little bit more about Sage and to be here with all of you today. So what I'm going to talk about first is the company, TS Restaurants. It is a family-owned, privately held company that was founded in 1977. These are our two founders that unfortunately passed away already, both of them, Rob Tipo and Sandy Saxton, which is the T and the S. Rob and Sandy had early success in the restaurant industry. They used to be partners in the Rusty Scupper chain, which is it was a huge national chain in the 70s. They sold their partnership to Stouffer's Hotel, a Nestle subsidiary, in 1975. And then they tried to take some time off and decide what they wanted to do because they were just barely turning 30. And what they decided was that they wanted to stay in the restaurant business, but they wanted to do it their way. You know, they had lived on the road. The restaurant industry, for any of you who are familiar, you know it's grueling. I mean, it's, 80-hour weeks are common. You're never home. And they just really wanted to do something different. They wanted to have a lifestyle company, which today doesn't sound like that big of a deal. A lot of people talk about lifestyle, but when they talked about it, this was 1975. So this was definitely a novel concept, and it wasn't anything that you were seeing in the restaurant industry for sure. But they wanted to do it their way because they wanted to focus on their friendship and their families. So today, TS has 7 concepts. Duke's, which we have 6 of them. We have 2 hula grills. We have Jake's here in Del Mar, Kioki's, Kimo's, Leilani's, and Sunnyside. Those 7 concepts comprise of 13 restaurants today in Hawaii and California, with some of the best views in both states. 11 of our restaurants are oceanfront, and 1 is on the west shore of Lake Tahoe, where you can actually drive your boat in to come and see us. So what Rob and Sandy started with before they had all of this amazing real estate was a plan. And the story is that they wrote this plan on a cocktail napkin. I have no idea if that's true or not, but knowing them, it very well could be, because I've seen some napkins with some pretty amazing things written on it from the 2 of them. But this is what they set out to do. And again, this is 1975. What's interesting about all of these points on the plan is that every single one of them apply today, 43 years later, and every single one of them apply today. And this is what we base the whole company on, is we constantly go back to this plan. The other amazing thing about this is because of how Rob and Sandy started the company being rooted in family and friendship, is these are also the foundation blocks for our culture. So if you look at what does it mean to have great restaurant real estate, well, or waterfront real estate, well, for them, it was being in places that you love. Architecture that honors the location is about belonging to the locals and making sure that locals felt like the community felt like this was their restaurant too, not just a place for tourists, not just a place to make money. Managers who are partners, that wasn't just about a business decision, that was about building trust and loyalty and dedication. And I'm going to tell some more stories that show the longevity that has happened in TS. And so as you go down through each one of these points in their business plan that was supposedly written on a cocktail napkin, you see the foundation for our culture. And again, we use both of these, the business side and the cultural building blocks today in 2020. This is our mission statement and our values. And our mission is to create timeless memories and lifelong friendships with sunsets and aloha. Yes, we are in the restaurant business, we serve food, but that's not our mission. That's the way that we are able to connect and build relationships and have meaningful moments and be a part of people's most treasured memories. That's why we serve the food, is to get to that. That is our goal. That is why we are here. So we get to be the backdrop for people's birthdays, their engagements, any special occasion they might be having. Maybe it's the first time they ever saw the ocean. Maybe it's just Tuesday and they just wanted to come out and be with us in one of the restaurants. It doesn't matter what it is. We get to be that setting. We get to be that place where they can come and feel safe and create these memories and build these lifelong friendships. And it truly is a privilege for us. That's how we look at it. In fact, I have a letter that I just got maybe about a year ago from a daughter whose mother has Alzheimer's, and she wasn't doing well. And every summer they used to go to Hawaii and they would have hula pie, which is our signature dessert. And they found out that we had a restaurant in California that they could go to. So they came to Jake's Del Mar, they had hula pie, and she sent me a picture of her mom with the biggest smile on her face. And her mom had some recognition when she was eating the hula pie and said she felt like she was on vacation. So those are the things that we are privileged and honored to be a part of. It's not just about serving food for us. And then if you look at our values, ohana is the Hawaiian word for family, and it's very deliberately first because we started because of two families. We're family owned to this day, and we are a family within the company. So pre-COVID, we were about just under 2,500 people. Right now, we're about 1,000, unfortunately, because of the impacts of the pandemic. But we know we'll get back up there again, and then we'll build from there because we have this ohana. We have people so dedicated to the company. And then our other values: continuous improvement, serving our communities, pride in our employees, and fun. You'll see a lot of this is very people focused. Some of the other values that you might, think that you would see in a restaurant company are just standards for us, like safety, cleanliness. We expect that all the time. So these are the reasons that we get up in the morning. These are the reasons that we're in business, and these are the reasons that we're proud to be here 43 years later. So why does all this matter? Why does culture matter? Why does the TS culture matter? I really love this quote by Peter Drucker that culture eats strategy for breakfast. And we see that time and time again, particularly when you look at the fast pace of the business world. And I know a lot of people are in different industries, but the advantage that TS has of being family owned and privately held is we always have the long-term view. So I remember I was working with a consultant, and he asked me, what would your board say if you told them that you could save 2 points off the bottom line? And I said, they would ask me how I'm doing it, and they would ask me what the impact is to our employees. And he didn't believe me because he was a retired big public company executive, and he really didn't believe that that's how a group of owners would operate. But that's exactly how our company operates. Everything is about, are we staying true to our values? And then how are we being financially viable for the future? TS is, like I said, it's not just a restaurant company. We are a family. We are an ohana. I'm drawn to the restaurant, to this restaurant company because of my personal values growing up and as a Polynesian. But you don't have to be from Hawaii to feel that. It doesn't matter where you're from. Everybody wants to feel like they're important. Everybody wants to feel like they matter. And that's what we strive to do with our culture. So just some more practical reasons, why would a business want to focus on culture? Well, I'm sure you've all seen all of these, the 4 main reasons. Engaged employees are going to be more productive. They're going to stick around longer. And people really care about culture, especially within the last 10 years, this new generation of worker, we get asked all the time, well, what else do you do? How do you give back? What's the culture like? Those are questions that we weren't really getting even 20 years ago. And so that really shows that employees want to be a part of something bigger than themselves. And also when you have a great culture, everybody can have a lot more fun, or at least I think we have a lot of fun. And then if that's not compelling enough, here are some numbers that I pulled from Department of Economics University in Warwick in England. They studied this for a number of years and found that happy employees are 12% more productive. And then interestingly enough, unhappy employees are 10% less productive. So it's not just about being more productive, it's about how your unhappy employees are going to impact your workforce. And then of course, poor culture equals 4 times the turnover. You'll be amazed at the longevity that is in TS. In fact, we kind of have the opposite problem. Sometimes, when it's time to move on, people have trouble moving on. And so, definitely a poor culture is going to lead to more turnover. And then this number, it's a couple of years old, and I would venture to guess that more than 41% of job candidates research culture before applying these days. I don't know if anybody on the call had stats on that, but I wouldn't be surprised if that were much higher. So I have a real life case about what a strong and meaningful company culture can mean to someone. And that's me. So I'm going to talk a little bit more about my beginnings. So like TS, my origin story began in the Pacific Islands. My mother was born and raised in Samoa, which is right there in the middle of the Pacific. She moved to Hawaii when she was a teenager. And then we moved to San Diego when I was about 2 years old. My father wasn't around, so I was raised by a really strong Samoan mother. I did well in school, and I was actually the first person in my family to go to college. I got accepted to USC. So I went there, but this was my first lesson in culture fit. I didn't know anything about going to college because nobody in my family had gone to college before me. And we didn't come from, I didn't grow up with any kind of money. We struggled financially because I was from a single parent household. And USC was just really large and really wealthy and really overwhelming for me. And so a semester in, I knew that I just couldn't stay there. And so I went home, and home was then Maui because my mom had moved to Maui after I graduated from high school. So when I went to Maui, I got there and I was just filled with shame because not only did I feel like I had failed myself, I felt like I had failed my entire family. Because being the first one to go to college, I was supposed to do great things and lift the family up. And I hadn't done that. So I came to Maui with a huge amount of regret, feeling really dejected, but I knew I had to get a job. And so I did. I got a job at a restaurant called Leilani's. I was 18 years old, and I became a hostess. Leilani's is part of the TS Restaurants family of restaurants. So little did I know that this would be the only job I would ever have, my first one at 18. I ended up transferring to a year later back to San Diego to try to figure out school. And I became a part of the management team. And in February, it will be my 32-year anniversary with the company. I've had a lot of different jobs with the company, hostess, office manager, controller, VP of operations, and I've been CEO for 5 years. So part of what has propelled me in my journey, a huge part actually, is my culture and the values that I grew up with because of my culture. And some of those are pride, pride in where I come from, who came before me, and most importantly, who comes after me. Tradition, which is about honoring the past. We're always looking back to our ancestors, to our traditions, to our practices, and making sure that we honor that, which is just as important as building our future. And then family. Family is absolutely everything in my culture. Everything you do represents your family, which is why I had such a hard time leaving USC and feeling like that was a burden on my family. But I know that everywhere I go, my family is with me. So because of these Polynesian values, it probably doesn't surprise you that I ended up in a family-owned company for 32 years. And this company is based in Hawaii and California, which are the two backdrops for my life. And I know it might seem like a Cinderella story, but just like Cinderella, there were some really hard times. My family, my culture is strong, but we struggled financially, as I mentioned before. My father was not around. He left when my mom was pregnant with my younger brother, and he was an alcoholic. So he did nothing to help support us. So if you look at statistics of what I was supposed to be, I am 74% more likely to commit a violent act based on my childhood. I'm 3 times more likely to become an alcoholic. And my highest education level should have been high school. And then these are just the averages for kids in my situation and how they grew up. But my mom taught me that anything was possible, and that if I could dream it, it was okay if I couldn't see it. I just had to dream it, and then I could achieve it if I worked hard enough. And that was so empowering for me. And then you look at those averages, and it really doesn't matter, because I don't ever plan on being average in anything that I do. So as far as the statistics go, Stacy mentioned I was valedictorian of my MBA class. I've never committed a violent act. I am not an alcoholic, although I did drink a lot of wine when COVID started. I'm not going to lie. But I'm really proud of the journey that I've had. And it's not just because of my mom and the influence of my family, but it's also in large part to the influence of one of the founders of TS, which is Sandy Saxton. He was the most humble, most generous man that I have ever met. And when I say generous, I don't just mean with money.
Am I the only one she froze for? No.
Nope, she's frozen for me.
Yeah. This is where I come in and ad lib. No, just kidding. I don't want to scare you away. Let's see. She popped off. She's coming back. Jennifer, this is always the way it goes in the big show, right? Only when you least want it to happen. All right, so was I the only one who got a little teary-eyed at the letter and like the statistic read and like some of those things? Okay, it might be Thursday, maybe it's just me, but it got me. Brian, if you're there and listening, she mentioned knowing you. I'm curious how you guys met or how you know each other.
Oh, I belong to Entrepreneurs Association organization also, and a friend of mine, Kevin Schneider, at a software company, he's in YPO with her, and we met at a house party before COVID.
I was gonna say, what? No,
and I've been going to Duke's restaurants for 20 years, and I love the Aloha spirit, and I thought it'd be great for her to share her story.
Oh, and I'm sad the technology wasn't cooperating. I think it was a perfect, capstone to our program here, but she's just coming back in now.
You're on mute. She's on mute.
Yeah. Give it a second. She might be collecting the audio too.
Okay. Hi.
There
so
she
sorry.
is. Not at all.
I just wanted to leave you all with the clip.
I made up the whole rest of your story.
You do? Great. Well, I'm almost done. Let me get back to okay, let me go back to my screen. There we go. Okay, so Sandy Saxton. I'm not sure where I left off, but basically is the most important person that I met outside of my family. So when he decided to take an interest in me as an owner of at the time we had 15 restaurants, it really had an impact on me. It made me feel seen. It made me feel valued. And I owe him a tremendous amount, but he didn't just participate in me as his employee. He also came to my wedding. He took my son out to dinner when he was struggling in school. He went to my son's football games. He and his wife, Dana, were our first guests when I bought my first condo, and he actually helped us to get into our first condo. So he became a really important part of my life and a big reason why I'm able to sit here with all of you today. So TS took this 18-year-old hostess at Leilani's and nurtured her into a CEO. And I never dreamed that my first job as a hostess would become a career or a home. But it's that culture of aloha that TS embraces. That's something that's so important to me as a person and as a Polynesian woman, that keeps me there and keeps me excited to be able to contribute to the success of this company. So we stay because of the culture. Like my executive team, our average tenure is 23 years. I have GMs that have worked with the company for 40 years. We have servers who have been with us for over 30 years. You know, it's kind of the joke when people get to a 5-year anniversary, it's like, oh, you're still new. That's what the culture does, is you feel like it's your family, and then you feel devoted and you want to do everything you can to make sure that the company continues. So Legacy of Aloha is the name of my talk, but it's not just a descriptive phrase for what TS is attempting to leave, how TS is attempting to leave its mark, but it's also the name of our foundation. Since the beginning of the company, we've honored our value to serve our communities. We prefer to make an impact through grassroots efforts. For instance, we clean up parks, local parks and beaches. We've sponsored hula and ukulele programs. We have internships at local high schools. We, in disadvantaged areas, we sponsor surfers with disabilities. We try to reach out to communities and really promote the values of TS and also the beauty of the places that we get to be in. But we did realize that we could have a little bit more influence if we had a foundation with a few company-wide initiatives. So one of the things that Legacy of Aloha does is this generous slice of hula pie. And we've done a handful of them now, but we'll choose a day where all of the proceeds of hula pie sales for that day throughout the company will go to a certain cause. The one that we just did over Thanksgiving weekend was we ended up donating a few $1,000s to the American Foundation for Suicide Prevention, because one of the horrible effects of the pandemic has been this feeling of isolation and the intensity of mental illness. So we've recognized that, and unfortunately had some tragedies within our own ohana. And so we want to make sure that we're able to give back in a bigger way. Another thing that we do are our Legacy of Aloha scholarships that benefit our employees and children of our employees. So the foundation is just getting off the ground. It's only about a year old, and now COVID hit, but we're excited about continuing to build that so that we can leave a true legacy of people who will then pay it forward. So let's talk a little bit about COVID-19. It's been devastating to the restaurant industry. You know, everything you read about restaurants struggling is all true. And here's my pitch, is that if you have a favorite restaurant, especially a neighborhood restaurant, please support them as much as you can, whether it's to-go food or if you're able to dine there. I know that it's deceiving sometimes, is that you go in and maybe there's a wait or maybe they seem full, but I promise you, unless the restaurant already had a viable fast food or takeout and delivery service going pre-pandemic, I promise you they are not doing well despite what you see. We're at less than 50% capacity. So imagine in your own businesses, if you took a 50% hit, like that's the maximum that you could do is 50% of your revenue. And then you don't do that every day. So that it is really trying times for the restaurant industry. Luckily for TS, we have been around for 43 years and we have resources available to help us get through this, but it's been incredibly difficult. In April, I had to lay off and furlough over 2,000 people. And it was heartbreaking because, like I've talked to you all about, we are in Ohana. I know many of these people. Some of these people are literally related to me. My brother worked at one of the restaurants and I had to deliver him a furlough notice. My niece, she got a layoff notice. So it's very trying times, and it still is. We're still going through shutdowns and restrictions and trying to figure it out. And then there's additional costs, of course, with the safety and protocol the safety protocol that we have to follow, which we do willingly. We were doing a lot of these things even before they were mandated, because our number one priority is the safety of our TS Ohana and our guests. Our second priority is the long-term viability of the restaurant. And then our third priority is how can we serve our communities? So even through all of this, we've continued to provide meals to our Legacy of Aloha partners, to community centers, Boys and Girls Club, Food Bank. We sponsored an Urban Surf Kids event earlier in the summer. So we know that other people in our communities are struggling too. And even though we still are making sure that we do our part. So COVID has also highlighted the importance of our culture, because when I personally sent out the notices of furlough and layoffs, because it's the first time in our company history we ever had to do that. Each general manager called each person to let them know what was happening before they received the notice from me. And then I got back almost over 100 emails from employees thanking me for everything that TS has done from them. This is after they got a layoff notice. So that's the power of the culture, is because they trust that what we're doing, they're not just numbers to us, that we know who they are, they're people, they matter. And that even though this is a painful time, it's a shared pain. And there's something really powerful about that. And our culture is what's going to get us through, because this is why we fight. We believe in our mission, we believe in our values. So we keep moving forward towards that brighter future in order to leave a legacy of Aloha. So that's all I have for slides, and then I'll stop sharing, and I'm happy to take any questions.
Well, thank you so much. That was amazing. I know that there will definitely be questions that pop in. Mr. Yui's already asked, how have your sales been affected by the quarantine in Hawaii versus sales in other locations?
Yeah, it's interesting because in California, we recover quicker. So we were able to open the California restaurants in late May. And then through the summer, the California restaurants were right about 50% of previous year volume, which was good. Who knew you would celebrate being half of what you were? And only 3 restaurants in Hawaii were open at that time because of the travel quarantine. We opened those 3 because we thought we could get enough local business to sustain. And they were running about 20% of prior year. Now, since the October 15th opening of the state, the Hawaii restaurants were running about 50%, and then the California restaurants started to decline because of the restrictions and the weather changing. So they flip-flopped. But whatever happens on the west coast of the mainland US influences what happens in Hawaii. So Hawaii is already starting to enact further travel restrictions. And hotel occupancy rates were at projected to be at 50% in December. They're dropping rapidly, and now they're right around 20%. If California goes on a lockdown like we expect it to any day now, that will, of course, probably take the occupancy rates back into the teens. So we're we're going to finish the year probably about a third of what we did in 2019. And that was with a record first quarter added into that. So it's really the tale of, I can never get a break, basically. It's like I'm excited for one region and then the other region is bad. And then when the other region starts to come together, the other one goes off the rails. So yeah, right now, Hawaii is okay because we've got some visitors still on island that we're serving. But we anticipate that that's going to decline and we might have to reduce hours and reduce staff again.
Jim. I was personally curious about being a female CEO. I'm curious if TS, has ever had a female CEO before, and how that might have impacted your leadership, if at all.
No, in fact, I was the first female CEO, the first female vice president of operations as well. Very surprising, not as surprising when I got to this CEO job, but everyone was shocked when I was named vice president of operations for California. My path was not typical. I was not typical, but luckily my predecessor gave me a shot, and I certainly wasn't going to waste it because I knew how that was. It's a male-dominated industry. It started to be a lot more representative of our population now, but the company was all male-dominated. In 43 years, we've only had 2 general managers of restaurants, and so a lot of women a number of years ago would leave because even though they loved the culture, they didn't see themselves in those higher level positions. And so they didn't ever really think that it was possible. And I guess that, for me, I think about it as I want to make sure that I'm setting the right example, not just for women, but for possibility. I want to make sure that people look at me and say, oh, I can do that. I had a hostess one time, just recently, I walked into one of the restaurants and she said to me, I can be you one day. I said, absolutely, you can. So I love that I can represent those possibilities for everybody. As far as being a female CEO in the company, I go through a lot of things that other females do. If I walk in with my CFO somewhere, they go straight to him and think that I'm the assistant or the girlfriend. They don't give me credit for what I do until I tell them what I do. So there's a lot of that, but it's okay because then the look on their faces when they find out that I'm CEO, it makes it worth it, right? But we also, after I became CEO, the family appointed a female chairman because the family members always served as chairman. And so even though we don't have as much gender diversity as I would like in our top leadership right now, we do have the top 2 positions filled by females, and we have a pipeline of amazing, diverse leaders that are ready. They're ready. We just need to get through COVID and start growing again.
Well, speaking of that, what's been the total number of team members now versus prior to COVID?
Yeah, so we're at 1,000 now. We were at 2,400 pre-COVID. And, we'll get back up once we're able to fill the restaurants the way that we could before. But, we've made a lot of changes. So we had identified before COVID, we had a whole plan of how we were going to be more efficient in order to enact our growth plan, because we had a very exciting growth plan that we were ready to work on. But we did recognize that we weren't doing things as well as we could because we'd been around for so long. There were a lot of habits that needed to be broken. There were a lot of personality-driven decisions. And so actually what COVID did do, one of the very few silver linings, was it gave us the opportunity to enact a lot of things that we were already waiting on or we had already planned on, and we just accelerated it. Mm-hmm. So we've been able to reorganize, restructure the entire management team The entire executive leadership team has all been restructured. The whole accounting, HR departments have all been restructured. So we won't get back to that level. So if we went back to those volume levels from 2,400, we would probably be about 2,000, just because we're going to be a lot more efficient, which is going to help us to continue to grow.
That's a pretty good lean improvement, right?
It
Again,
is.
for the silver lining that you want to find there.
Right.
Exactly. I really particularly loved your original plan, from, 43 years ago or whenever it was. I'm curious, was there ever a time where you guys deviated for whatever reason? And what happened? When did you recognize you had left the plan, and how did you get back on course?
We did. And I, we had a lot of success. We've grown in every year except for recession years. And we grew organically all the time. I mean, it was amazing, and it was a lot due to the people and then our locations. So there was a period of time where we took that for granted, and we had some deals that weren't at all reflective of the plan. And we ended up selling those places. But what it was we were just trying to grow, and we were excited about it. And so we started making deals that weren't good deals. And then once we got in it, we were so invested emotionally, because we talk about our culture and we talk about you're part of this family, that then we weren't able to make those clear, objective business decisions that you really need to make. So that was probably about 10 years ago. And then what we did to recenter ourselves is we had a 3-day relevance workshop with all of the top leadership, and it was facilitated by one of our board advisors, who's the former president and CEO of Burger King. He also ran Pillsbury Restaurant Group. And he facilitated this relevance workshop. And that's where we came together and decided, okay, who are we and who do we want to be? And how can we not rest on our history, but build a bright future? And that was the turning point for us. And then we brought the plan back out and went, oh yeah, we have this. Why don't we just do this? So that was our big turning point.
That's great. And I appreciate the mental commitment that you make, the emotional commitment to a decision, and then, the bravery and courage to kind of course correct back, that's what keeps people from going off track, right? So congratulations on that courage. Another question here for you is, what changes have you seen with your supply chain?
Actually, very little. And that's because we try to buy local every opportunity we get. So we're working directly with farmers, especially in Hawaii. There's a dairy farmer, a goat cheese provider that we used, and they were in danger of going out of business. And so they started adopting out their goats. So we adopted 2 goats from the goat farmer on Maui to make sure that they could stay in business. So very, very little supply chain. I mean, we had trouble getting hand sanitizer stations, just like everybody else did. We had a little trouble finding heaters at one point. But as far as our food and our product, everything was coming from local or domestic providers, and we basically didn't have any disruption. So we were really proud of that too.
Did you name the goats?
They were already named. Yeah.
Okay.
Daisy and Jasmine.
That seems appropriate. Yeah. You got to name the goats. So one last question for you, I think, unless somebody else will chime in, is what would you say? I've heard you use the word aloha quite a bit, right? So what, I guess, maybe, a definition of it from your perspective, what's the best part about managing with aloha? And do you think having the aloha philosophy has made a huge difference in everyday operations?
So aloha, what you've probably heard is that aloha means hello, goodbye, and love. But actually, if you translate it, it's alo is to be present, and ha is the breath of life. So aloha together is to be present in the breath of life. And when you go to Polynesia, the Polynesian triangle consists of Hawaii at the furthest northern point. And there are commonalities throughout all of the Polynesian nations. And one of the commonalities is the honi. And the honi is a greeting. And what you do is you touch foreheads and you breathe in together. And then you greet each other. And the reason for that is that Polynesians recognize that the most treasured gift we have is our breath. We can't survive without it, right? You can go a few days without food and water, but you cannot survive minutes without taking a breath. And so for Aloha, it's all about that interconnectedness. It's the responsibility that you feel as a person and having a relationship with other people, and how your whatever you do impacts directly and indirectly everyone around you. And so this sense of Aloha is really about responsibility. It's about connection. It's about being present and understanding that it's not just about you, that it's about the whole, and everything you do will impact the whole. And so absolutely, Aloha has an impact on everything that we do. And it doesn't mean, a lot of people will misunderstand it too. It just means you have to be nice all the time. And that's not what it means. I mean, we're business people, sometimes you have to make those tough calls, and sometimes you have to have conversations that are not very nice, but they're always respectful, and they're always done for the right reasons. They're not done to, put anybody down or to put them in a bad place, but they are done to make sure that you're taking care of your responsibilities and you're bringing everything along, and that you're honoring the responsibilities that have been given to you, and making sure that by being present, that you're bringing out the best in yourself and the best that's possible in the people around you. So everything is about Aloha for us, and making sure that we're reaching out to our communities, that we're doing right by our employees, that we're doing right by our good employees by not keeping bad employees around. And so there's a lot that really goes into it. And it's really more about a feeling than a word. So the feeling that we want people to have is that they will be treated with respect, they will be treated fairly, and that they matter to us.
At the end of the day, that's what matters, right? I mean, I always say we're never going to be on our deathbeds wishing we had sent more emails or wishing we had attended one more meeting, but we are going to be wishing we had had one more connected moment, one more, treasured opportunity with a friend or a family member or somebody that we care about. So.
Absolutely. And also, I don't know if you know this for people who travel to Hawaii a lot, but Aloha is part of legislation in the state. So it's a part of a way of life in Hawaii, and with the company having its roots in Hawaii, it just makes so much sense that we would honor that and follow that. And then, of course, with me as CEO coming from a Polynesian background, I take every opportunity to make sure to reinforce it.
That's great. Well, maybe we get the Polynesian dance, and, we can we'll pick some of the boys out of the next time we get to do a presentation in person. Ross loves to wear coconuts and, shake his grass skirt.
A few Mai Tais, and I will get everybody up there.
Exactly. And we'll have some fun. No COVID style.
Yeah.
That's great. Well, again, thank you so much. This has been absolutely wonderful to hear your thoughts and your ideas. Yes, I see little clapping going on by my little windows. Exactly. I'm sorry you didn't get more verbal feedback, but I don't know if you're up for sharing your presentation. I know this group loves to consume things post. We'll have a recording. I guarantee they're going to watch it then too. So as much as you're willing to share, we'll put out there and make available to the rest of the group.
Thank you.
Jackie,
Yeah,
Jackie, thank you so much for sharing your story. It was very inspirational. I really see the Aloha spirit every time I visit Dukes in Kauai. Thanks again for speaking to Sage.
Thank you so much. I'm really glad to be here. Hopefully I can meet more of you in person one day.
Exactly, instead of the black squares.
Yeah, I
know. and a white set of names. That's great. Okay.
Yeah.
Well, thank you so much. And I'm going to move to kind of do us a little recap here and make sure that folks are kind of thinking about, again, what's the 1 or 2 top takeaways from today? You know, we had some very powerful looks forward into 2021 from our economist, and, you know, she shares a very optimistic lens. I was actually very excited about that. And, you know, I will take the hope and run with it. And then Jackie here, of course, was absolutely amazing. You know, with the core plan is critical. I wrote that down. You can carry that forward for decades. Think about who you're influencing. People stay because of your culture. And Aloha equals connectedness. And I think at the end of the day, that's what we're all striving for. So I really encourage you guys to, again, as you move forward and you start to think about what does 21 look like for you, to take some of these ideas that you heard about and see what of them could I implement and have an impact in my business or on my team or on my life or on my health or on my spouse or on my, you know, whatever, fill in the blank, right? So I want you to dream big and think big about where you can go. And with that, I will give you back your next hour and send you guys on to hopefully putting some of these wonderful things in practice. So with Aloha, thank you so much for your Sage Talks event. Thank you, guys.
Everybody.